Before we actually get onto the economics of the stock market section, we're going to remain in the technical aspects, sort of flirt between the two here. We're going to talk through a couple of markets that you should aim at and other markets you should avoid. Now, if you are a shares trader and you are relatively new to trading, what we would say is stick to FTSE 100 companies and certainly avoid penny shares. I have been trading for many years and all of my portfolio is FTSE 100 companies. I do not own a single share in a penny stock. Penny stocks do sort of invoke gambling in a way because what people do is they think they're going to double their money and they make a punt. It's not to say you can't invest in these companies, but they are a bit of speculation because a lot of them are based on commodities such as oil fields or gold mines. And how can you value a company when they don't really know what assets they have? It's all a little bit of guesswork and speculation and putting money down on a punt. FTSE 100 companies, they are a lot safer bet. If you make a mistake, you're only likely to make a 2 to 3% loss. If you make a mistake on a penny share, you could easily see 30% wiped out in one day. So stay away from penny shares and stick to FTSE 100 companies. You can go to FTSE 250, but focus most of your portfolio on FTSE 100. If you have a CFD account, we would make a strong recommendation that you start trading the S&P 500. It's a lot less volatile market, and most of our trades that our team make is on the S&P 500. We started using the S&P 500 and we sort of got used to it. So stick with that to start off with and learn the trade through that. Try to avoid try to avoid oil and silver. There's an old saying about trading crude oil. It can break a rich man and make a poor man even poorer. It's a very difficult market to trade. Once you've been trading for over a year, maybe you might want to attempt to trade it, but really you don't need to. There is so many different markets. If you are going to trade silver, we would recommend that you don't. It has quite a wide spread. If you are going to trade it, then use hit and run tactics. Basically, get in, get out, and leave it alone. Don't play too long with silver. Gold is another relatively difficult market. It can, at current valuations of gold, can move against you very quickly or move in your favor very quickly. It attracts a lot of traders to it. It's not a bad market, but maybe not suitable for beginners. Try to avoid markets such as cocoa and maybe even the Nasdaq. They've got quite a wide spread, which means the difference between the buy price and the sell price. So that as soon as you buy, you're down quite a bit because it's got a wide spread. So try to trade things with a short spread. And this is another thing with penny shares. Sometimes the spread on penny shares can be a good 6%. It's so hard to make a trade when you've got to make 6% just to break even because the spread's wide. Whereas if you're trading something like Tesco, the buy price is near enough the same as the sell price. Whereas on something that's 5p a share, it might be 5p to buy, and then as soon as you own the shares, they might be worth 4.5p because that's what the bid and the ask are. So stay away from penny shares, try to stick to markets with low spreads and stick to FTSE 100 companies, certainly in the first year of your trading career.